Hello there, investorholics and friends. Today we'll be taking a look at Fortescue's March 2020 quarterly production review. Bit of a highlights reel at the front here, and then a deeper dive towards the end. So hang around, definitely worth the effort. Well, hello there, investorholics. This is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's jump on into some highlights. So Fortescue share prices outperformed its peers in the broader market after posting its quarterly report and upgrading its production guidance. On Thursday, it lifted its annual iron ore shipment forecast after a whopping 10% rise in the third quarter shipments. Management is keeping costs under control amid the coronavirus pandemic. So to date, FMG has minimised any impact from the virus outbreak, saying the iron ore shipments and customer payments remain unaffected, even as it conserves cash to guard against a prolonged downturn. In March, shipments from Port Hedland were continuing to schedule despite curbs on movement and activity in the country, though exploration activities have been suspended. Record third quarter iron ore shipments of 42.3 million tonnes. That is an increase of 10% on the Q3 financial year 19, so last year, same period. Year-to-date shipments are a record at 130.9 million tonnes. C1 costs of $13.27 a wet metric tonne, and that is 2% lower than the same time last year. Robust demand for Fortescue's products, delivering average revenue of $73 a dry metric tonne. Fortescue's major projects achieved milestones in the third quarter, with capital expenditure guidance for the financial year 20 revised to between $2 billion and $2.2 billion, reflecting expected timing of cash outflows. Based on a strong operating performance year-to-date, guidance for financial year 20 shipment is upgraded to between 175 to 177 million tonnes. C1 cost guidance of US $12.75 to $13.25 a wet metric tonne. So see a comment here from the CEO, Elizabeth Gaines. Fortescue's strong operating performance in the March quarter has delivered record shipments increasing 10% compared to the prior comparable quarter, and a 2% reduction in the C1 costs, maintaining our industry-leading position. This result underpins the upgrade to our full-year guidance for shipment. She went on to also say that Fortescue is a core supplier of iron ore to China, and we see strong ongoing demand for our products and anticipate a steady recovery in economic activities in the market. While the global economic outlook remains uncertain, our balance sheet has been stronger, and we continue to generate sustained cash flows and jobs. Invest in growth and focus on delivering returns to our shareholders. Very positive indeed. So as we touched on before, I think there was some positive news. The miners' operating costs also dipped, so the C1 costs fell 2% in the March quarter to $13.27 per metric tonne over the same period last year. However, the C1 costs were actually up 6% over the last quarter, which is largely due to a higher strip ratio. This means that FMG had to process more waste to extract the same amount of ore. I don't think the investors should be too worried about the C1 costs, as they're still, pretty bloody low in the scheme of things. There was also a potential worry that Fortescue would incur higher expenses from having to work under tight social restrictions due to the Western Australian restrictions for the COVID-19 pandemic. But typically when you lengthen rosters, that actually reduces your costs, so you don't have as many people on site and you don't have the same amount of costs associated with getting people there. Just reduces your costs. They've probably actually seen a reduction in costs by a third. That's my guess anyway. Fortescue received an average of $73 per dry metric ton, and it painted an upbeat outlook for iron ore, as we touched on before from the CEO. The miner is forecasting C1 costs to average between $12.75 and $13.25 per wet metric ton for this financial year. Fortescue expects a steady recovery in economic activity in China, that it sees strong ongoing demand for its products from the world's top metals consumer. So let's have a look at BHP. So they've confirmed their iron ore production output for the rest of the year. But they think that the global steel production, excluding China, could drop sharply this year. Rio Tinto and Vale have cut output forecasts for key metals due to disruptions from the virus. So we saw a record third quarter iron ore shipments from Fortescue of 42.3 million tonnes, and an increase in the full year guidance. So I think that this lift in production has potential to cause Fortescue's share price to appreciate in the short to medium term. But it's interesting to see the different views. So the other majors like BHP, Rio and Vale all have a little bit more pessimistic view of the world, if you could say that. So as we touched on before in the quarterly highlights, management expects to ship between 175 and 177 million tonnes of ore this financial year. There's definitely a few things helping out the iron ore price, and by extension helping FMG out. So you're still seeing that restricted iron ore supply, and that's mainly from Vale in Brazil. So they're down roughly 90 million tonnes per annum, and I don't think that's actually going to get better anytime soon. They've got some issues with dams, or new issues with dams anyway. You're also seeing some closures in India and South Africa, just for the sheer fact that we've got the coronavirus floating around. Rio has also got some additional problems with effects from the previous cyclones, and I haven't actually noted here on the slide, BHP have actually had some quality problems as well. So there's quite a few things actually helping to prop up the iron ore price at the moment, and that actually, it's definitely allowing FMG to take advantage of the current situation, which is good if you're a shareholder. So a little quick look at dividends and some ideas. So I think in recent years, Fortescue has been quite disciplined with their capital allocation, has used a lot of their cash to pay down their debt, and they also pay some very good dividends to the shareholders. Previously, Fortescue had the potential to pay, I reckon anyway, $1.50 in dividends. I don't think that is likely now because of the focus on capital management, as highlighted earlier on in the presentation, and also there's just a lot of uncertainty surrounding what's really going to happen with this COVID-19 virus and how that's going to affect the broader economy. So there's a few analysts around the traps. So have a look at here. FN Arena, I think you're going to get $1.43. And obviously there's already 73 cents that being paid. Thomson Reuters, I think you're going to get $1.49, and you've already seen that 76 cents that paid. So that, if they were actually paid out, I think that'd be higher on the end of the payout ratio. So my feeling is that the dividend is more likely to fall on the more conservative side of the payout ratio, which is 50 to 80% full year net profit after tax. Currently it's been paid out at 65%, so I think it's going to stay somewhere around there in that ballpark. So if the iron ore price holds, Fortescue remains a free cash flow yielding monster, probably for the next 6 to 12 months. Things will hold up well. So this is my expectations that the mine will undertake a capital return of some sort when it releases its profit results in August. I think most things are looking pretty strong. The only thing that's going to really affect the iron ore price and the dividend payments is if there's a second or third wave of the coronavirus, mainly in China. I think that's where the big demand is coming from at the moment. So if something catastrophic happens there again, that's definitely going to affect it. But if it just ticks along as it is now, I think everything's looking good for at least the next 6 months, so towards the end of 2020. So hopefully everything just holds up until the end of this year anyway. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.